Thank you for watching the CEO Barbecue. My name is Antonio, and today I'll be looking for gold in Utah together with Hugh Agro and John Meyer, who are respectively the CEO and VP of Engineering and Development at Revival Gold. Before we get into the actual interview, though, I'd like to warn you that we have received monetary compensation for the production of this video from the company that's being interviewed. Please understand that this channel is a business that sells content producing services to companies, which means you cannot rely on this video for research, and you should treat this as an advertisement instead. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. Please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record because your capital is at risk, and I am neither a licensed financial advisor nor do I have a good long-term track record. If you're not 100% sure you understand 100% of the disclaimers I just showed you and told you about, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said therein. That all said, Revival is listed as RVG on the TSX Ventures Exchange, where over the last 3 months, an average of about 130,000 shares have traded daily. The stock's 52-week high is 44.5 cents, and its 52-week low is 22.5 cents. With a market cap of 78.5 million Canadian dollars and 210 million shares outstanding, today this is a 37.5 cent stock, with a 50 and a 200-day moving averages at respectively, and I'm rounding up, 32 and 30 cents. There are close to 50 million options and warrants outstanding, bringing the number of fully diluted shares to, and again rounding up, almost 260 million, meaning an increase of about 23% in shares outstanding can be expected if all diluted securities get exercised, which would then result in about a 19% ownership dilution if, and that's of course always a big if, but if those actually get exercised. There's only about 18% of those shares that are actually believed to be held by retail investors, whereas management and advisors own about 15% of the company. High net worth individuals own 19%, and institutions and corporate partners own 48% of the company. I'd normally shut up already because you and I have done 2 interviews over the last 3 months, and of course they're in a playlist on the channel, which should be linked in the description of this video as well. But Revival has published an updated interim financial statement, which shows us the numbers for the 6 months ending on December 31st. And remember, this is before they raised over 3 million Canadian dollars with Dundee Corporation in early March. So keep that in mind as I'm going through it. But the last balance sheet, again, December 31st, it shows me a little under $2 million in current assets, most of which at the time, it was about $1 million, was recorded as cash and cash equivalents. And it was about $700,000 in the form of prepaid expenses, whereas all the liabilities were comprised of $1.8 million worth of account payables and accrued liabilities due within the next year with no long-term debt. Moving on to the expenses for the 6 months that ended on December 31st, Revival recorded a total of $3.6 million in operating expenses, although that includes over $330,000 in share-based compensation. So let's call it $3.3 million is what's the out-of-pocket cost for the 6 months, which was an average of, let's call it 550,000 Canadian dollars on a monthly basis. About 65% of that money went toward exploration and evaluation, whereas 35 or an average of $190,000 a month went toward running the company, also known as GNA, diving further into the breakdown of these expenses for the exploration expenses. Specifically, it is drilling, geology, and site costs that made up the largest chunk at about 41%. Project management and administration made up about 25% of the cost. Technical studies combined with property costs and permitting made up the rest. On the G&A front, it was salaries, director fees, and consulting fees combined that made up the largest chunk, sitting at 35%, whereas investor relations was a close second at just over 30% of the cost, with various smaller expenses making up the rest. In terms of ratios, I already told you it was a 65 to 35 split for the exploration to administration ratio, whereas the drilling to marketing ratio sat at about 2.6, meaning a little over 2.5 times as much money was spent on drilling, geology, and site costs than what was spent on marketing. I also noticed that Revival is ramping up marketing in the current quarter, so hopefully that's something Hugh and I can discuss later on in the conversation. However, please understand that I am not infallible, so I might be making mistakes in my reading or interpretation of these numbers. So to stay safe, please use setterplus.ca yourself and make sure you're getting the full picture. For Revival, over the last couple of months, that full picture has been focused on Utah, where they were working on a brownfield heap leach PEA, which was just published using a 5% discount rate and a $2,175 per ounce gold price, and showing the potential for what I would call mid-scale operation. To build a mine, Revival estimated, this is estimated under an AACE Class 5, needing $208 million in initial capex and working capital, which resulted in a 26.5% post-tax IRR and a payback period of 3.6 years. The LOM here is estimated at just under 10 years, and the all-in sustaining cost is estimated at $1,363 per ounce of gold, assuming an average annual gold production of just under 100,000 ounces for a total of just under 1 million ounces over the 10-year LOM. And that's at a strip ratio of 2.8. A PEA is, of course, preliminary in nature, so your normal PEA disclaimers apply here, and there is obviously no guarantee any of this will actually be completed. But what the chances are that all of this is going to work is what we've come here today to try and understand. So it might be prudent of me to consider actually shutting up at this point, and Hugh and John giving you both the word here. But thank you for being here.
You bet. Great to be with you, Antonio.
Pleasure's all mine, of course, and I'm looking forward to the barbecue here. But let's start you off lightly as the call is maybe heating up a little bit. Who's this PEA for? Or let me maybe clarify, but who did you make this document in mind for? Like, is it for retail shareholders to better understand what you have? Did you prepare it with a takeover in mind? Is it for the government? Who's it for?
Yeah, ultimately, it's for our shareholders. And the initial use of it for us, of course, is to demonstrate that the project we acquired just on a year ago ticked the boxes that we set out for it to tick. And I can tell you, we're feeling really good about where the PEA came out relative to our objectives. And remember, our objectives a year ago were to bolster our heap leach production scale, and secondly, shorten our timeline to potential free cash flow from gold production. And we've done that. This project is going to take us up to a pro forma 160,000 ounces a year of gold production from first phase heap leach on our two assets. And it will allow us to move more quickly as the permitting timeline here at about 2 years is almost half the permitting timeline on our founding asset, Beartrack Arnett in Idaho. No less important to us, very large gold resource there, 4.6 million ounces. And we certainly have not left that one be over the last year as we've progressed Mercer. But our main objective with this PEA was to tick those boxes on the acquisition. And then beyond that, to help us find the next places to go explore, to add value to the project, to look for those places where there's, as I say, low-hanging fruit, to continue to explore, and to set ourselves up for the next phases that move us to free cash flow. That's our primary objective at Revival Gold, is to become self-sustaining and deliver cash in this gold price cycle.
Multiple things to touch upon there, and hopefully we'll get to talking about Beartrack Arnett here toward the end. But you say that the expected timeline to complete the applicable baseline studies and mine permitting here is approximately 2 years, which at first glance, and I know we touched upon that last time you and I spoke, Hugh, but it looks too fast to me. Can you explain what exactly needs to happen here, and why you believe you'll be able to complete everything in that period, whereas normally in the US you're looking at 7 to 10 years, potentially longer in some parts of the US?
I'll hand it over to John. He's the permitting expert on our team.
Sure, there's some unique aspects of the project that give us confidence that we can permit this project much quicker. I'd say starting with the fact that there are no perennial streams on site. So we don't have things like fish to manage and worry about. Groundwater is very deep. It's below the bottoms of the pits, so that's another nexus that the feds tend to get involved with, which simplifies our permitting project. Overlay that with the fact that the project is all the resources and footprint of the project are on private land. That's the way we develop the project. There are some areas that we will need rights of way associated with BLM land, but those are not the same regulations that govern mining. So when you combine the lack of resources, resource areas, and that's what we refer to when we're talking about things like groundwater, surface water, and others, and the fact that we're on private land, those things really stack the deck in our favor. But there's one other issue that I think is important to consider when permitting a project in Utah, and that's that in Utah, the state agency, the Department of Oil, Gas, and Mining, they're the lead agency in terms of permitting, regardless of whether there are federal areas involved. And so they have MOUs with all the major state and federal agencies. And so they are the lead agency. And they have shown historically and that, that's a good way to do things. When it's led by a federal agency like BLM or like the Forest Service, things are in all likelihood going to be slower. So that's why we're confident we can permit this project more quickly.
And I just throw in there too. Remember, Revival Gold's strategy from the start has always been to go to projects where gold has been successfully produced in the past, and that brownfield status at Mercer gives us a lot of technical insight, data, and it gives us the confidence that we've got community support for the project, which is often one of the things that can hold these things up. And so those things also impact our ability to move more quickly here. We understand the site really well. It's been managed very well in the past, and we've got a lot of data to work with.
Community engagement is exactly where I wanted to go with this, because I was wondering what kind of assumptions are you working with there on the community side? What kind of consultations need to happen? What's really the process from here on out before you're actually pulling gold out of the ground?
Yeah, so I'll say this. We're at the start of the process here. So it's a little bit difficult for us to map out every specific detail, but I'll give you some examples of what we've done at Beartrack Arnett in Idaho. We've had regular community open houses, annual open houses where we've gone through questions and we've explained what we've been doing. And I expect we'll do the same things at Mercer. We've already been into the Office of Dogum that John alluded to, this state office that manages the process of permitting in the state of Utah. And so we've had engagement there. We've also had our initial discussions with some of the key resource area consultants, for example, cultural and wildlife, to be able to understand the data that's available, and what are the things that are going to be of most interest to the state regulators. And so that gives us a lot of confidence. And further to that, our team has been in touch with the municipality, Tooele County, to understand what it is that they're looking for. And I can tell you in a nutshell, it's jobs, jobs, jobs. Tooele, the town, about 40,000 people, about 40 minutes away from us, is a blue collar town, with a focus on the practical things around generating activity in the economy. And lastly, Antonio, just on the subject of community engagement, fortunately for us, our nearest, biggest neighbor is the U.S. Army with a weapons destruct site. And of course, we don't have a lot of concerns about noise or dust with those folks. We're in a very good location in terms of mining. There's permitted quarries nearby us, and of course that past operation, which demonstrates that we can act successfully on this site.
What other implications does it have that your neighbor is essentially the defense side of the U.S.?
Yeah, normally, and we've come across this in some areas in Nevada in particular, where if you're next door to a particularly sensitive U.S. government facility, you've got to be really careful about what you're bringing onto the project, and you've got to be careful about what you're doing on the project with people and equipment, because of the sensitivity around surveillance, equipment, and those sorts of things. So in our case, we haven't had any issues at all, or there's nothing strategic or sensitive that is going to cause us a lot of issues here. Again, these are early days, so we will do more work in regards to all of these aspects. But from our current view and with the information we have currently available, and based on the past track record, it's a pretty cooperative situation, pretty cooperative part of the world we're in.
So you don't expecting needing like higher security clearance for your personnel or something like that once the mine is up and running?
No, no. In fact, there's a public highway between us that separates us from the U.S. government, and there's no issues with the public using that highway or the areas around it. And there are public lands in the area as well, so not an issue.
No Area 51 exciting stuff there then.
No, not that we know of.
I believe you said you'll be drilling more this year. Last time we spoke, is that still the plan?
Yeah, look, we're working on those plans right now and the details related to them. We've already set out in the press release related to our PEA some of the high level objectives. But John and I were speaking with our geological team earlier today about pinpointing locations for drill holes, doing the formal steps around organizing that program, drill contractors, bidding, all of those good things. So I would expect that sometime in the next month or two, we'll formalize plans. We do want to get back in with work this season as soon as the snow clears and we're ready to go. And it would involve drilling, metallurgical test work, and of course, we want to get busy with those permitting activities as well.
Met work is definitely what we're going to be talking about. That's what I'm writing down. When does your season start again?
So we'll be able to get out there and into the field. So because we've got different elevations, but broadly into the field within the next a month or two.
Okay. Is this drilling or the first round of drilling, is that going to be focused on converting the because you have about 600,000 plus ounces that are inferred right now that you've used for the PEA. Do you want to convert those to indicator, or is this the first part of the drilling? Is it going to be focused on step out?
John, do you want to address that question?
Sure. Well, we're generally planning the drilling at site kind of on a two-phase basis. What we'll be focusing on in the first phase is really conversion, ounce conversion drilling. So we'll be focused on that from the perspective of doing that with RC drilling. We'll also be obviously collecting data through that, not only geologic data, but we'll also be collecting samples for assays and for cyanide assays. And the cyanide assays are a piece of the metallurgical database will be bolstering. So RC drilling in parallel, we're going to want to do some core drilling. And core drilling again can form a couple of needs. Firstly, geologically. Secondly, metallurgical samples that we'll be gathering for subsequent column leach testing, and also geotechnical testing. So the core is going to be done. We'll want to do that in parallel in the first phase, so that we can get going on a lot of the network. But just know that the columns that we'll be doing as part of the next phase of engineering, which is kind of pre-feasibility level work, the columns will be bolstered by the cyanide assays that we're going to be doing, and again, bolstering our existing database with all the drilling, whether that be RC drilling and or core. So the reason I say 2 phases, and the first phase will involve that, is that, of course, you learn things with every drill hole. You learn areas you can step out. You learn areas that you want to infill more. And so we'll be starting off the first phase with kind of a not as tight a drill spacing as what we'll then go back up and maybe tighten it a little more in select spots in the second phase. So hopefully that makes sense.
It does make sense. And I do have follow-up questions here specifically about, again, the med work and some of the rest. When do you think you're going to be doing some step outs, or you're going to Porphyry Ridge or West Dip and some of that more, news exciting drilling, if you will?
Yeah, so our priority, sorry, John, our priority is going to be the more boring stuff that John's been describing. The infill drilling to convert inferred to M&I, the metallurgical column testing, which is required to get more distribution spatially across the deposit for metallurgical data. That's going to be the priority, but we absolutely want to be doing some exploration. And there are several areas that are of interest beyond expansion to the existing mineral resource as it's been defined, that are pretty exciting. The one that I think is most interesting to us is in the South Mercer area. We call it the Mercury anomaly. We've got a very permissive structure of the sedimentary unit, which leaches well, which continues for about 900 meters, almost a kilometer outboard of the existing deposit area, and there's no drill holes there. We've got great structure. It's not very deep for drilling purposes, and it's I would say first on our list from an exploration point of view. And we will look to get to that later this year.
So which targets do you think you're going to be able to get to? I mean, I mentioned Porphyry Ridge and West Dip, and then this one. Which targets do you think you're going to get to?
Well, what I'll say right now is, as we develop up the planning, I'm pretty sure that the Mercury anomaly in the South Mercer area will be tops on our list for Greenfield's blue sky exploration. And then we absolutely want to get through some RC drilling for conversion purposes, some core drilling for metallurgical test data. But all of that will formalize and put more specificity to in the next month or two, Antonio.
That's one of my favorite words, by the way, specificity, and only because I just recently learned it, and I'm no longer stuttering on how to pronounce it. Are you guiding anything in terms of how much of these ounces in a PEA could end up being converted or picked up in the PFS?
I won't put John on the spot with having him answer that question for you. Here's what I would say, is that we've got tremendous amount of drilling into this deposit. I believe it's around 260 or 270 kilometers of drilling into the resource area. So we've got lots of drilling. What we need is to get some additional metallurgical test data to be able to validate the inferred and convert that to measured and indicated. So it's less of a burden, I think, than if we were talking about a deposit that hadn't been extensively drilled and modeled. And so I think we're in good shape from that point of view. And rather, I prefer to think that there's opportunities to actually expand on the resource. Now, here's the challenge. One can spend years and years and years drilling off a deposit, and maybe that's a good strategy for some. But our strategy is to move this project forward into free cash flow, and then use the internally generated free cash flow to organically grow through exploration. So I think this is a case where we can have our cake, so to speak, and eat it too. It's some 6,700 hectare land position. It's one of these very permissive geological systems, a Carlin type system. And we've got, as you've pointed out, lots of targets on it. So what we want to do, move to free cash flow and then continue to grow without having to go and buy a new project to fill our pipeline for future growth.
But what is your, maybe to give me a better idea of what you're hoping for here, what's your internal hope or target for considering that work a success? I mean, you want to see a 1 million ounce, 100,000 ounces a year for 10 years in the PFS at least for you to move forward with it? Or do you, I mean, how do you see it? What do you want to see?
Yeah, I think that's a good way of looking at things here. What I would say is that this PEA has certainly woken up a lot of market participants. You asked earlier about who the audience for this report was. Well, it's ultimately it's our shareholders for our shareholders' benefits. But there's a lot of other parties that are looking at this PEA and saying, boy, that's a project with scale in the Western United States with low risk and with very compelling returns. And, I think we're attracting a lot of a new interest to Revival Gold as a result of getting this PEA out. And that brings me to the next point here, which is I don't mean to be cagey with some of the answers about what are the next steps, but frankly, we've got right in front of us a lot of work just to get the news out on this PEA, the results, the technical data that sits in our electronic data room, the geological model, the block model, the metallurgical test work, all of the mine planning. All of that has got to be digested by these sophisticated corporate and strategic financial folks who are taking an interest in what we're doing here. And we want them to do that. It's really important to being able to surface the best future funding plans and strategic plans for the company. And that's going to take us, a month to maybe even 3 months. And we're really looking forward to that because we've got a lot to show off.
I do want to talk about how you're going to finance it. So I'll make a note to get to it maybe toward a later stage, but I'm kind of still holding an idea in the back of my mind, which is to talk about the MET program. What, John, maybe this is your domain more to talk to me about, but what exactly do you want to do? Variability tests, detox studies? What's the shebang going to look like this year?
Well, I explained the drilling because that's where it starts. That's going to set us up for collecting samples. We're going to be developing a more uniform understanding of the leachable gold throughout the deposit by cyanide assaying everything that we sample. I guess I would just say, and you mentioned this earlier in the call regarding the carbonaceous material. That was one of our key concerns early in the project. So we invested a lot of time to better understand that issue over the last 10 months. And so what it involved is us, scanning thousands of drill logs. We then used both brute force with people and AI to then pull various pieces of data off the logs. A key piece of data that we pulled off the logs was the carbonaceous materials. And so with that data in hand electronically in a usable format, we then developed kind of a 3D model of what were logged as carbonaceous zones throughout both inside the mineralized areas and outside. So doing that, we also then developed a 3D model, consistent with our block model of the leachability of the resource as well, using thousands of cyanide assays. And then what we did is we developed a correlation between our column leach test data and the cyanide data, so that then we were able to populate the entire area. And as you mentioned earlier in the call, what we did from a mining perspective to try to reduce the risk of us having that carbonaceous material report into the heap leach. Carbonaceous material that the testing showed was still leachable. We basically said, okay, it's leachable, but what we don't want is the potential for that to foul up the heap leach. And so when we run into it in the first 8 years of mining, we stockpile it, and then we leach it at the end of mine life so that it doesn't have the potential to impact those first 8 years. So looking forward, what we'll be trying to do is bolster that relationship with additional data, both in terms of cyanide leach data and column testing. We'll also be doing other metallurgical testing, specific preg robbing testing, etc. But all this is trying to build up to get us to a place where we have confidence in the overall metallurgical recoveries for the pre-feasibility study. Does that make sense?
It's starting to. I'm probably the furthest thing from a metallurgist you're going to speak to, at least today. But maybe you can kind of simplify the methodology here that was used to map and isolate that material in the pit shell. More because I'm thinking about, like, I understand you've done some studies and you're telling me what they've showed you, but how do you know it's not going to bleed into earlier leach cycles and kind of throw off your production that way?
Well, that's obviously what we can do now is with all the geologic logging that we have, we think we have a good understanding spatially of where these zones are. They do tend to occur, and just keep in mind, Antonio, that we've not only modeled our deposit, but we've modeled all the mined out areas. So we and in fact, that's probably predominantly where much of the carbonaceous material is, because it generally occurs higher up in the lithology than deeper. So if you think about the way the mining occurred historically with Getty and Beartrack, previous open pit operators, they were mining kind of the nearer surface materials, and we're mining the halo around that, which tends to be deeper, and it tends to the fact of the matter is that the previous operators mine more of the carbonaceous material on a percentage basis than certainly we would be.
And that's resulted for you in a 75% recoveries, what you've come up with for this PEA. How confident are you that they'll stay at or at least close to that number for the PFS and actually during production?
Yeah, I think that what we've done is we've tried to use every ounce of data that we could to develop the best estimate we could. We feel good about that estimate. I don't have a sense of whether that number is likely to go up or down. I think what we tried to do was be appropriately conservative with the information we had to develop a best guess. I hope the numbers go up. I don't think they will, but I also don't expect them to go down a lot. But that's why we have to do all the work that I just mentioned. We got to get through the work. It's critically important to, before we take this first shovel, we got to be confident in those metallurgical recovery estimates, and that's what we're going to do.
So just a couple of things to add to John's comments, which I think are bang on, and it's the kind of leadership that John brings to the process of doing that work, setting it out, setting the objectives for it, getting in the right consultants. We haven't talked at all about the people who've done the work and getting the A team and making sure that that team is focused on the things that are really going to matter. That's John's bailiwick. That's where his expertise lies. And it's really important you have the right people doing this stuff. But I can just add a couple of other things. First of all, we went in with our crush at 1/2 inch. And this was predetermined because the samples had already been prepared before we got to the scene here. And so the test work that we've done is on 1/2 inch crush. Now, we're certainly going to explore the opportunity to go to a finer crush, a coarser crush, and see if there isn't even a better optimization on crushing, both in terms of costs, but also in terms of recovery. Secondly, and this is huge, this project is really, really looking good for heap leach based on the rapid recoveries, the rapid kinetics we're seeing in the columns that we've done. We got over 90% of the recovery within 5 days. And just to compare that, some of these projects that we've looked at more recently, operating assets that we've done due diligence on, the leach cycles on these things can be over a year. And so if you think about that, that's a lot of capital tied up in a leach pad. You're not getting back into the revenue, and it soaks up money, it soaks up time and cost of capital. So that's a second big advantage of what we're seeing thus far in the column leach test work we've done, and how that might apply to our project. We may be able to get quicker responses here. And I think we've got a nice setup for those recoveries that we did get. So that brings me to the third point, which is our column test work showed recoveries in several different lithologies hosting the mineralization of well over 80%. And the average recovery we've assumed as part of our very extensive metallurgical and geological block modeling was 75% in this in this PEA. And I think there's some opportunity around that to potentially do better. As John mentioned, as we go deeper, it's the case that we're not running into more of the carbonaceous material. Actually, we're running into more oxidized material. And in the lower grade blue stratigraphic unit, we've got some excellent recoveries. We've got some really interesting grades, especially where we get cross faulting structures, these so-called karst zones. That's only going to enhance things here for us. So lots of opportunities, definitely lots more work, as John has pointed out, for us to do, but also some really interesting opportunities beyond the exploration, just in optimizing what we've already done.
John, have you worked on or looked at similar deposits anywhere else in the world, or maybe in Utah itself, where it's similar lithology, similar chemistry, just similar grade? You're working 0.6 year average grade, if I'm not mistaken. Have you seen anything like that work out before, and how did that go?
I think the grade is actually a positive aspect. I mean, I think there's a lot lower grade, and I've certainly worked on low grade projects before. But I think where I would argue that Merkur is most unique, that I have never seen before, is that the oxidation. Generally speaking, most deposits, the oxidation, as you go deeper, you're more likely to get into sulfides at depth, and that is just not the case that we see at Merkur at all. In fact, we see at Merkur is that any sulfides are very high up in the stratigraphy, and of course, much of that is gone as a result of it being mined by Beartrack. So we're kind of left with the fact that yes, our grade is lower than what Beartrack mined, but it's more pervasively oxidized at depth, and I think that that's unique. I think I've not come across that.
But in terms of again, lithology and chemistry, you don't necessarily see a direct comp or a project that's currently operating that I could look at.
Yeah, it's a Carlin hosted deposit. So from that perspective, geologically, it's very similar geologically to many of the deposits in Nevada. So I think that's where you would draw the best parallels for us.
Yeah,
it's interesting. It's interesting. There's so many different circles of knowledge and familiarity around this Carlin type system that we're in, and people often ask, well, just a second, don't those Carlin type systems come from Nevada? Actually, this was the first Carlin type system identified. And it's outside of Nevada. It's in Utah. It's still in the basin, the so-called area of district of rocks that are permissive of this kind of deposit. It's not the only Carlin type system in Utah, and actually there's Carlin type systems elsewhere out of Nevada and Utah, but most of them are in Nevada. And as John points out, we've got lots of examples of projects like this. As to the grade, I would point out that we're twice the grade of a number of our peers. So there's lots of margin here in the rock. Our all-in sustaining cost for this project is about $1,360 an ounce. And I've got to emphasize that that's a very current number. Obviously, we've just come out with the PEA, and that compares with our peer heap leach projects in the U.S., and this is the Western U.S. So, lower 48 we're talking about here for the most part, that are running about 1550, 1560 an ounce. So lots of margin here on this project at 6 grams per ton. Lots of precedents for discovery, not just near surface discovery, but I'll tell you what our chief geologist is most interested in. And by the way, his expertise comes from Nevada. He's a master's geologist out of Reno, Nevada. He's a co-discoverer of the Silicon deposit in Nevada, some 12 million ounces that AngloGold's working on. And his interest is in some of those layers in the sedimentary unit at depth, and the possibility that we've got high-grade deposits like you've seen in Nevada, 4 Mile, Cortez Deeps, that are underpinning some of these the most valuable mines in the world. So lots of opportunities here. John's expertise, Dan Pace's expertise, our chief geologist, our board. We've got Larry Radford on our board, who's operated mines like this in Nevada and around the world. Norm Pritchard, another gentleman who's got a lot of experience with these kinds of deposits, having been the former COO at Eldorado Gold. And Wayne Hubert, one of our founding directors based in Salt Lake City. So very familiar with the community, the structure, and was involved in putting this land position together before Revival Gold got involved. So it's really interesting, the experience that we can draw upon and the familiarity that we have geologically, operationally with this type of deposit.
That's actually something that I also wanted to talk about. Do you and your team have specific experience in bringing U.S. operations into production? What about you personally, Hugh? I mean, where do you see, what do you want to do with your life? This is that talk. But do you want to remain CEO as the company goes into production, hopefully here over the next couple of years, or do you see yourself stepping down? Where do you see this going?
Yeah, so I'm a mining engineer by training, 35 years in the mining industry, mostly in growth in gold with senior gold companies, operators. And I want to build the next go-to name in the United States, North America generally, for gold. And I think that's the sweet spot. Going from a $200 million market cap to a $2 billion market cap is the sweet spot in the gold business. There just are not a lot of people who can have the patience, the wherewithal, the access to capital to be able to put together, and the creativity to be able to put together these very complex operations, because you're dealing with social, you're dealing with business, you're dealing with technical, you're dealing obviously with people. So there's a lot of aspects to building a great mining company, and doing right by not just shareholders, but also the community, also the people who do the work. And that's something that I'm really passionate about, is this wonderful life of building great mining companies. And that's what we want to do with Revival Gold.
Let's go back to what you want to do over the short run here. I also wrote it down. I don't know if it's too early, actually, John. I wanted to ask you that, but is it too early to do pit optimization studies and like geotechnical stability and pit slope studies and stuff like that? Or is that not something you're going to do this year?
It's absolutely not too early to do geotech studies. It's an area close to my heart. I'm a geotechnical engineer. We do have the benefit here, though, of course, of having the deposit mined in the past. So we're not starting from scratch. We obviously have all the existing high walls are still there, and we're able to back analyze what stood up In fact, there are also some sloughed surfaces out there that tell us what didn't stand up. So we have a good handle, I think, on the geotechnics. That said, when we're core drilling around the perimeter of the deposit and internally, we'll be regularly collecting undisturbed samples so that we can run geotechnical testing concurrent to our infill drilling and exploration programs.
Is that the thing you're most curious about to see an answer to this year? And essentially, where I'm going with this is thinking about what's the most pressing unanswered question. Is it the met work? Is it the geotechnical work? What is it that you really want to see an answer to?
I think because the pits are generally quite shallow. I mean, I think the deepest of our pits are really only about 150 meters. So the pits are generally shallow, and so the geotechnics aren't really driving a lot of the resources. If we steepen the slopes or if we shallow the slopes a bit, would we dramatically see a big delta in resource? Probably not. So it's something we have to do. It's important to do our homework in that regard, and we will. But I would say the bigger focus, certainly in this drilling season and in the fall and winter program, will be the metallurgical program as we grab the sample during the summer and fall. So that's a much bigger and I think more consequential piece for us to get a handle on as soon as we can.
As that moves forward and assuming positive results there, Hugh, I'm starting to think about financing the mine and as well as the IRR. You're at an estimated, let's call it 200 pre and about 350 total, $350 million total capex and sustaining capex and all that. But let's talk about the financing and the IRR because you've ran the PEA at 5%, which I know is the normal rate for gold projects in North America. But is that a realistic cost of capital in the current interest rate environment? And where do you go for that financing?
Yeah, so just a step back, in the gold industry, of course, we use a 5% NAV to remain comparable to our peers. And the 5% derived, I was around in this business when we first came up with this approach as an industry, 0% and 5% discount rates. It is entirely to do with the special qualities around gold being something that is inherently hedged against inflation. That's a separate conversation. But the reason why we do 5% NAVs in the industry isn't because the cost of capital is 5%. It's because it allows us to compare one NAV to another NAV. It's a standard, in the industry. So then the question is, what is the appropriate cost of capital as we think about potentially developing the project? And I think because this is a U.S. project, because we're 1 hour from a city like Salt Lake, where CAT has their U.S. operations based, for example, because we can borrow money with little geopolitical risk, premium, or challenges, and because the quantum of capital, $208 million, including all the working capital, including all of the capital associated with the leasing contracts on equipment, because it's a relatively modest number at $208 million, we have a lot of different parties we can go to. They're already banging on our door, banks, private equity groups, royalty companies, streaming companies, lenders of every sort are lining up for this project because of its location and because of its economics and simplicity, and this is a very difficult one to quantify, but the risk level is much lower because of the site and some of the things that John's been talking about technically and operationally. So it's going to have a high degree of lendability. We are going to have to raise equity, and I would say equity capital right now in the junior space is expensive. That is why we're looking at some of the solutions to that, which probably involve strategic transactions around key players, like what we've just done with Dundee, bringing in a strategic player that puts validation to the projects and bolsters our ability to bring money to the table. You mentioned on the outset that we've got about 48% of our shareholder base in institutions. These are large gold-focused institutions that understand opportunity as well as risk. And that gives us really a head start as we think about funding potential construction and even the steps before construction. Now, we've still got some optimization to do around that. A lot of conversations to be had over the next month or two, or maybe even three. But here's the thing about a gold company like ours. With 6 million ounces in the gold of gold in the ground, some $18 billion of metal value in situ, we don't have to worry about that getting up and walking somewhere else. We retain the land position, we retain our exposure to the gold, and so then it becomes a question of how do we optimize the financing structure that brings that gold value to the surface and allows us to generate free cash flow. And I want to emphasize that an operation like this will have revenues in the order at today's gold price in the order of about $300 million a year and margins of about $150 million a year. So this is a very precious asset in downtown USA, and I don't think we're going to have any trouble financing it. We can talk about specific cost of capital. We can talk about whether we use spot gold price or whether we use some discounted price to evaluate the project. But based on my experience and what I see, this is a very rare asset. Large geological system, permissive of a lot more discovery, clear pathway to free cash flow, relatively straightforward permitting, and there just aren't enough of these projects around.
I understand it's way too early, and this is very forward looking, but what does the ideal deal look like for you? You're mentioning royalties and streams and debts and equity, potentially asset level deals and potentially strategics. That's a lot of things kind of up in the air. What does a good deal look like for your case specifically?
Well, what I'll say is, we want to deliver the most value to our shareholders that we can. And, we trip up in this industry by giving value away too soon to royalties and streaming companies. Essentially the public private equity players in our industry. And so, we want to make sure that we get the right balance there. Let's have that conversation in a year's time, Antonio, as we're moving towards, the preparation for an actual financing structure for construction. I'd rather not limit our possibilities right now. We've got a lot of them in front of us. We got a lot of options. And that's one of the beautiful things about investing in a development company like Revival Gold at a time when the valuations for these assets are so low relative to the metal price. I mean, here we are today trading at 0.1 times the underlying NAV. If we were to think about this in terms of a price to ounces in the ground basis, we're talking about $8 an ounce in the ground relative to a gold price at $3,100 an ounce in the ground. That's about 380 times more value in the market for an ounce of gold than what we're currently enjoying in the ground. So there's a lot of upside to development companies like ours. The trick to unlocking that value is about progressing the projects technically as we were doing. There is, and I know you want to get to this, is why do these development companies trade so cheaply? I think it's one of those situations, and I think the analogy is, why does the S&P trade so expensively? Well, it does until it doesn't. And we saw in 2000 the NASDAQ index, the .com stocks were at these valuations that just not make sense. It was obvious to everybody in hindsight, and then all of a sudden they're not. And I think the same thing is true of the small cap space generally, currently very discounted relative to the big cap names due to the growth and trend towards passive investing, the crowds of people following momentum. But it's that way until it's not. And then I think we go back to fundamentals. Where's the free cash flow coming from? Where's the value in the stock market? And how do we get leverage to these commodities that are scarce and limited and increasingly in demand?
Are you going to have to raise capital again this year, by the way?
We will if we want to progress the project meaningfully. We've got sufficient cash here to progress through the next 4, 5, 6 months as we get out and tell the story about the assets and go through some of those strategic discussions that I alluded to earlier, and prepare for the next phase of growth here.
Within the context of what you just told me to the previous question here, Hugh, looking also at everything you've told me today as a whole, and of course, again, understanding that none of this is guaranteed and it's all forward looking, how much money do you estimate needing between now and FID before actually having that final financing package in hands and being like, okay, we're going to build this thing? How much money are you going to have to raise in the meantime? And of course, why I'm asking this, because I'm thinking how much dilution is going to occur in the meantime?
So we've spent typically in the order of $10 million a year. And I don't think that would change progressing things. We might spend more or less, depending on that, calculus around our share price and optimizing value for shareholders. And so really it's very much investor or strategic partner or a strategic corporate partner dependent. It's not just the thing that's important isn't just the amount of money, it's where it comes from and on what structure. But generally speaking, to be direct on answering your question, I'd say we spend about $10 million a year, and we could spend more, we could spend less, but that's typically what we've spent as we've progressed towards development.
And ideally, you're up and running in 2 to 3 years from now is kind of what you're hoping for, essentially.
That's correct. Look, this is a project that's unique in the United States. There aren't any of these kinds of projects around. We've got a few of our peers that are on public land, federal land, or greenfield sites, or both. Nobody that I'm aware of is in a situation where they've got a power line with grid power to site, paved road to site, office buildings, all of the data that we've been talking about available to them, and something that could produce at this scope and scale with this simple a process. We're not talking about shipping concentrate. We're talking about heap leach. We're not talking about complex pits. I mean, these are, as John was pointing out earlier, 150 meters deep. This is not complex stuff on a relative basis. It's located very well close to these towns, which means we can attract people. And believe me, there's a lot of people that want to live in Utah. It's a great place to live. There's a lot of recreational activities. There's a critical mass of people. John and I enjoyed a really good hockey game at the Delta Center in Salt Lake City with our colleagues about a month ago. It's a very livable place.
My idea of Utah comes from a movie called Salt Lake Punk, I think it's called. It's kind of a depressing movie, really. You shouldn't see it. But so maybe I should come on down there and see what it's really about.
I'll tell you what, you come during ski season and we'll show you a whole other side of things.
Yeah. It's
John
called
and I are
SLC.
both skiers.
It's called SLC Punk. I'm reminded now. So it's Salt Lake City Punk. Anyways, depressing movie. Don't see it. What the question pops up in my mind again, Hugh, and I think we've touched upon it in previous conversations as well. But you're mentioning strategics. Is there room for more strategics here? Because I mean, again, it's almost half the company is owned by some sort of institutions in one way or another. They don't typically trade. If you increase that ownership and you shrink down the retail ownership, isn't that going to limit the liquidity and therefore make it less attractive to new buyers? Is that something you're thinking about, and how do you see it?
Yeah, I'm sure if we asked some of our friends in that register, if they want to have a bigger competitor come into the mix, they might not be interested in that. But look, as shareholder fiduciaries, our objective has to be to make money for our shareholders in the long run. I mentioned those other two communities we have to look after. The people that are affected by our project and our communities around the project, and our people who need to be properly rewarded for the great work that they're doing. But our number one constituent here is our shareholders, and so we'll do what's necessary to maximize their value and opportunity. And there's a lot of interest in these development projects because I keep saying this, but we're producing gold at a rate of 120 million ounces a year. We're only finding gold projects at a rate of 10 to 20 million ounces a year. And if you go through all the things we've been discussing, converting a discovery into an actual mine, there's a lot of pitfalls, there's a lot of challenges, and we are significantly along the way with that de-risking process that takes us to gold production.
When do you want to have the PFS out by? Yeah.
I'll tell you, we'll give you specific next steps in a couple months' time, I'm going to say. Once we formulate our plans and have mapped out the schedule, it will all depend on our funding situation, where the market is in terms of support for all these activities. And we'll give you a detailed roadmap to what the next 12 months will look like. I would say at a high level, within the next 2.5 years, we'd like to be in a position to turn a shovel on the project. A lot of work has to be done between now and then, not just technical work, but finding the right financing and the right structure for that financing. But that's our big picture objective here as we move towards free cash flow and then optimizing through exploration. I mean, we've got this whole other project at Beartrack Arnett that we want to move along and that can bring added value to the mix. We've got our exploration beyond that we'd like to do. Lots of irons in the fire here.
Well, you're mentioning Beartrack Arnett, and I do want to talk about it because that used to be your focus for a while. Seems now to have shifted. Is Beartrack Arnett going to be taking the back seat here, or is something going to be happening there this year?
I wouldn't say it's the back seat. What I would say is that we have limited dollars to work with. Unless the market environment changes, overnight here, we've got to be very careful with how we spend money because every dollar we spend is dilution to our shareholder base, right? So if I got to spend a dollar on one thing or the other, my choice is going to be to move towards sustainability with free cash flow, and Mercer's, tops on the list for that. Having said that, over the past year, we've significantly de-risked the permitting schedule on Beartrack Arnett. We've completed a draft plan of operations. We've lined up a lot more of the geology with geophysical studies, structural modeling, soil geochem work. That's building out the business case for further drilling. Remember, at Beartrack Arnett, we've got 5 kilometers of mineralized trend and another 5 kilometers of trend on our property, now fully defined for future drill targets. And so we've got lots of interest in that and what's happening there. And by having two projects, it gives us some flexibility to be not just with our team, but in terms of our prioritization of drill targets. And so we certainly have not backseated Beartrack Arnett. It's very important to the overall story at Revival Gold. We don't get to 160 million ounces of heap leach gold production from 6 million ounces of resource by leaving Beartrack Arnett behind. It's part of our story.
Part of that story is also telling the story or being able to present that story to a larger audience. You said you're going to be marketing over the next few months as well. I saw a $100,000 contract here. What are you hoping to get out of this? And is this the kind of marketing that you're looking to do more of? And again, yeah, what's the expected ROI on stuff like this?
So the fascinating thing since I've been in the business and specifically on the street, I call it 25 years, the changes that have taken place. You know, we talked a little bit, or I talked a little bit about this move towards momentum investing, passive investing now, 13 to 14 trillion dollars invested in passive stocks. That is index funds that just follow market cap and sector weightings. And you have to be able to appeal to those folks. And that means building liquidity in your share trading activity. And it also is there's the other phenomenon that's happened, of course, is that the pace of information flow has picked up dramatically, and the amount of information. There are very few people that want to spend an hour and a half listening to a podcast as your audience appears to want to do. Most people are looking for the soundbite. And so we've got to be able to get out to those people. We've got to do it electronically. You physically cannot touch the number of eyeballs that need to be touched to be able to bring the liquidity, the traffic onto our story. We've got a great story to tell. If we're not going to tell the story now at $3,100 gold, trading at a P to NAV of 0.1 with so much upside in the story, I don't know when we're going to tell it. So yes, we've gone out. We've brought in a party to help us get out electronically to a lot more people and bring more eyeballs to our story. We have a great story. We have a great company. We have great individuals like John, like Dan, like Lisa Ross, our CFO, our general manager, Pete Blakely. These guys are doing fantastic work. And we want to bring a spotlight to that work and those great results that we're delivering.
It's I understand you're here to present a bullish story and that you're bullish yourself, but what is it that keeps you up at night? Maybe that's a question for each one of you. John, let's maybe start with you because you've been silent for a couple of minutes there now. What is it? What keeps you up at night? Like if you had a magic stick, you could just wave it at something and make it go away. What do you wave it at?
Well, I think I'll feel better when we're able to get out and drill and see more of the material kind of uniformly distributed. As you can imagine, a lot of our data is historical. So yeah, our predecessor Ensign, drilled a fair amount of holes to prove up the historical data, but we've got more work to do there. So obviously, we want to firm things up geologically, gold occurrence, metallurgy, firming up that historical data, and probably if I was to pick one discipline, it would be metallurgy. That will be and that will be our focus. I just want to add one thing to Hugh's comment about how much data we have, how much drilling we have. It's important kind of to note that a lot of the reason that in fact our inferred material is inferred isn't necessarily because of the geology and gold occurrence. It's more to do with confidence in the metallurgy associated with it and the leachability of the rock. So the part that indicated, that's where more of our data is. And so where the inferred is, yeah, we still have a lot of geologic data there, but we've got to bolster the metallurgy, and so that's why I've mentioned the focus on that, and that's what we'll be doing over the next year.
Hugh, what about yourself?
My chief concern when I go to bed at night is being able to maximize the value for our shareholders here. I mean, it really is compelling, and we're not the only ones who see that. We're not the only ones that are acting on it. There's a lot of folks that have the firepower to come in, and as a public company, we've got to be always thinking about the possibility that we get short changed with a bid that comes across the table before we're ready to really maximize the value for our shareholders. That's my chief concern here, trading at 0.1 times NAV.
Well, gentlemen, I think I've gone through most of the questions that I've had here. It seems like we have plenty to talk about in our next conversation as well, which is going to be about, I'm assuming, about your plans for 2025 more specifically. But I think I'm done for today. What am I forgetting to ask you? What did you come here hoping to talk about that I failed to bring up?
Yep, you've done a great job. It's the usual CEO company barbecue with the added benefit of having a John Meyer with us here to roast. Thank you, Antonio.
Thank you so much for your time, gentlemen.
Thank you.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. Also, unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find a company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."